Hi, welcome back to Mr. Money TV. Let us take a look at what's the difference between unit trust and ETF. For unit trust, generally you will buy it from an agent or a financial advisor. For ETF, you can buy it directly on the stock exchange, such as Bursa Malaysia. Next, management. In unit trust, the management of the fund is generally more active, while in ETF, it is generally more passive. For example, in unit trust, the fund manager will have to pick and select individual stocks to match its investment objective. For ETF, they will usually just set a category. For example, the top 100 largest US company in the US stock exchange. Then they will just track the performance of these 100 companies. Pricing of the units. The price of the units in unit trust are fixed throughout the day, while for ETF, it can go up and down throughout the day. This is because investors can buy ETF directly on the stock exchange. Therefore, the price of ETF's unit can change according to the supply-demand in the marketplace. Then the fees. In unit trust, they have a higher fee structure, while ETF has a lower one. Generally, in unit trust, there is an initial charges of about 5%, but for ETF, it is generally less than 1%. Minimum investment. For unit trust to open an account, generally you will need a minimum initial investment of around 1,000 ringgit. While for ETF, since you can buy it through stock exchange, you just need to buy a minimum of 100 units. For example, the FTSE KLCI listed on Bursa Saham Malaysia is priced at 1 ringgit and 73 cents per unit. So you just need to buy a minimum of 100 units. That will cost you 173 ringgit. The total expense ratio, TER. Total expense ratio is generally made up of the management fee of the fund, operation costs, trading costs, and so on, and all the other expenses. So generally ETF has a much lower TER compared to unit trust. And how this will affect your investment. Let's say when you invest in a fund that has a TER of 2% and that fund performed at 10% this year, what happened is your 10% return will need to minus the 2% TER, then you will only get back 8%. So TER will eat into the profit of the fund, and this is how it affects you. So it is generally faster for an ETF investor to recuperate their investment costs and see return compared to a unit trust investor. So thank you very much for watching this video. I hope that you guys has benefited from this video today and you get to know the difference between ETF and unit trust. I hope this helps you to make a better decision in your investment. Hi guys, if you're interested to invest in ETF, do check out this cool platform called Stash Away. They have a very easy to use system together with a good selection of US ETF funds in their portfolio. There's no minimum balance or deposit to open an account as well. On top of that, they have a kick-ass robo-advisor that manages your portfolio for you. So do check them out in the link below that I'll attach in the description. Oh guys, a good news! If you were to sign up for an account through the link that I attach below, you will get a 50% discount off your management fee for the next 6 months. So what are you waiting for?